Right now, somewhere in your portfolio, there's a stock you almost sold out of fear last week. And by the end of this video, you are going to be very glad you did not. Because what happened in the market over the last 2 days is exactly the kind of moment that separates the investors who build real wealth from the ones who panic at the worst possible time. Grab your coffee, get comfortable. Because today on Ticker Hawk, we are breaking down 5 stocks that I believe are sitting in a buying window most people are going to miss. And we are going to walk through exactly why. Before we dive in, if you have not subscribed to this channel yet, now is the moment to do it. Because we cover moves like this every single week, and I do not want you finding out about the next opportunity after it has already happened. Hit that subscribe button. It genuinely helps this channel grow, and it costs you nothing. So let us talk about what actually happened. 2 days ago, the market got spooked. We had a new voice step up to the podium for the first time, and the moment investors heard even a hint that interest rates might stay higher for longer than expected, everything sold off. Stocks dropped, gold and silver dropped, even Bitcoin dropped, and for about 24 hours, it felt like the rally we had all been enjoying was finally running out of steam. If you were watching your account that afternoon, I would not blame you for feeling a little uneasy. That is a completely normal reaction. But here's the thing about markets that nobody tells you when you are starting out. The scariest looking pullbacks are very often the ones that turn into the best entry points, because the underlying story did not change in 24 hours. The economy did not change. The companies did not change. What changed was sentiment, and sentiment swings far more violently than fundamentals ever do. And sure enough, by the next session, the market had already clawed almost all of that loss back. Every major index finished green. The reason is simple once you step back from the noise. A handful of policymakers saying they would consider a rate hike later this year is not the same thing as rates actually going up. The broader trend, the one that matters for long-term investors like us, still points toward easier policy down the road, not tighter. Inflation pressures have been cooling, energy prices have been soft, and there is real incentive on the policy side to keep this expansion going rather than choke it off. None of that means there will not be more bumpy days ahead. There absolutely will be. But bumpy days are the entry fee you pay for long-term compounding. They are not a reason to step away from the table. Now, I want to be upfront about something because I think it matters more for the kind of investor watching this channel than for anyone trying to trade in and out every week. This is not a video about timing the next 24 hours. It is about identifying companies strong enough to shrug off a scare like this one and keep compounding for years. If you have been investing for any length of time, you already know this pattern. Every year there are 2 or 3 moments where the headlines convince everyone that this time is different, that this is the pullback that finally breaks the trend. And almost every single time, the companies with real staying power, the ones with strong balance sheets, loyal customers, and businesses people actually need, come out the other side stronger than before. That is not blind optimism. That is simply what history tends to show us decade after decade. So when I build out a list like the one I am about to share, I'm not asking which stock might bounce the hardest over the next week. I'm asking which businesses I would be comfortable holding through another 10 years of headlines, just like the one we saw this week. So let us get into the 5 names I am watching right now and why each one earns a spot on this list. The first name is a company most people recognize from their phone or their laptop. But very few investors truly appreciate just how dominant its position has become in the artificial intelligence build-out. I am talking about Microsoft. This is a business that touches nearly every corner of corporate America, from office software that companies cannot function without, to a cloud computing division that keeps winning enterprise contracts year after year, to a stake in some of the most important artificial intelligence partnerships on the planet. What I like here is the combination of a fortress balance sheet, a dividend that has been raised for close to 2 decades straight, and a growth engine that is still in its early innings. Think about how many businesses you interact with every single day, your bank, your local hospital, the company you used to work for, that are quietly running on top of this company's cloud infrastructure without you ever realizing it. That kind of invisible, deeply embedded presence is incredibly hard for a competitor to dislodge because switching costs for a large enterprise are enormous once they have built their entire operation around a particular platform. When the broader market wobbles the way it did this week, quality businesses like this one often get dragged down with everything else, even though nothing about their long-term story has actually weakened. That disconnect is exactly where patient investors find their opportunity. If you already own shares, days like this are not a reason to sell, they are a reason to sit on your hands and let the business keep doing what it does. And if you have been waiting for a better entry point to start a position, a pullback driven entirely by interest rate headlines rather than anything fundamental tends to be exactly the kind of window long-term investors should be paying attention to. The second stock on my list is one that does not get nearly the attention it deserves in financial media, and that is exactly why I like it. It is a company that sits at the center of global semiconductor manufacturing, and I am talking about ASML. Here is what makes this business so interesting. Every advanced computer chip on the planet, the kind that powers your phone, your car, and every artificial intelligence data center being built right now depends on equipment that essentially only this one company makes. That is not an exaggeration. It is closer to a monopoly than almost anything else you will find in public markets. There's no second or third option for the most advanced chip-making equipment in the world. There is essentially one supplier, and every major chip manufacturer on the planet has to go through them. When governments talk about bringing chip manufacturing back home, when companies announce new factories, this is the business standing quietly behind nearly all of it, supplying the machines that make any of it possible. What makes this even more interesting for long-term investors is that these are not one-time sales. Once a chip factory installs this equipment, it needs ongoing servicing, upgrades, and support for years, which creates a steady stream of recurring revenue layered on top of the equipment sales themselves. Shares have had their share of volatility this year, the way most semiconductor-related names have, but the long-term demand picture for advanced chips has only gotten stronger, not weaker, as more and more of the economy becomes dependent on computing power. Any pullback driven by short-term rate worries, rather than anything wrong with the actual business, is worth paying close attention to. Third on the list, and this one is going to feel a little different from the first two, because it is not a technology company at all. I am talking about Johnson & Johnson. Now, I know healthcare stocks do not get people excited the way artificial intelligence names do, and that is exactly the point. This is the kind of stock that quietly protects your portfolio when the more exciting names are having a rough week. It has paid and raised its dividend for over 6 decades, through recessions, through pandemics, through every kind of market environment you can imagine. And that streak alone tells you something important about how this management team thinks about its shareholders. People do not stop needing medicine, medical devices, or healthcare innovation simply because the Federal Reserve is debating whether to raise rates by a quarter point. Demand for what this company sells is about as steady and predictable as it gets in the stock market, which is exactly why it tends to hold up so well when more cyclical, more speculative names get hit hardest. The reason I am bringing it up right now is that the stock has lagged the broader market this year, and that gap has created a more attractive valuation and a dividend yield that is sitting well above where it normally trades. For anyone in this audience thinking about retirement income or simply wanting a piece of the portfolio that does not keep you up at night, this is the kind of holding that has earned its reputation the hard way, one steady year at a time. Before we move to the next one, if any of these names are already sitting in your portfolio, drop a comment and let me know. I read every single one, and I am curious how many of you are already positioned in these. The fourth stock I want to highlight is a name built around something every single one of us does without even thinking about it, and that is Costco. I bring this one up because in uncertain markets, the businesses that win are the ones people keep spending money at, no matter what is happening with interest rates or the headlines on a given day. Costco has built a membership model that creates an almost embarrassingly loyal customer base, and that loyalty shows up in renewal rates that consistently sit above 90% year after year. Think about that for a second. 9 out of 10 members who pay for that card every single year choose to keep paying for it, even though they could easily shop somewhere else. That kind of recurring, predictable revenue is incredibly rare, and it is part of why this stock has been such a consistent long-term compounder even through multiple difficult economic stretches, including periods where consumer spending across the broader economy was clearly slowing down. It is not the cheapest stock on this list by traditional measures. Quality businesses like this one rarely are. But for investors who would rather pay a fair price for a wonderful business than a cheap price for a mediocre one, days when the broader market pulls back on rate, fears are exactly when names like this become a little more reasonably priced. I would much rather own a handful of shares in a business this dependable than chase something flashy that might not even exist in its current form 5 years from now. And the fifth stock rounds things out with a different kind of business entirely, one tied to the simple fact that the world is steadily moving away from cash. I'm talking about Visa. Every time someone taps a card at a coffee shop, checks out online, or pays a bill through an app, there's a very good chance this company is quietly taking a small cut of that transaction without ever taking on the credit risk that a traditional bank would. That last part is the piece a lot of new investors miss. This is not a lender. It does not sit there worrying about whether someone defaults on their balance. It simply moves the money and collects a fee for doing so, which means it carries almost none of the risk that weighs down a typical bank stock during uncertain economic periods. That is what makes this business model so powerful. It scales with the growth of the global economy itself, and it does so with margins that most companies would dream of. Even with some short-term noise around regulation or competition from newer payment platforms, the long-term trend toward digital and cashless payments has not slowed down. It has accelerated, especially as more and more commerce shifts onto phones and apps rather than physical wallets. When markets get nervous about interest rates, financial sector names sometimes get caught up in that selling. even when their actual business has very little direct exposure to rate moves. And that is the kind of mismatch worth watching closely right now. So there you have it. 5 businesses that I believe are well positioned to handle whatever the next few months of interest rate headlines throw at the market. Each one dominant in its own space. Each one with a kind of balance sheet and customer loyalty that lets it keep compounding through noisy periods like the one we just went through. None of this is about chasing a quick bounce over the next few days. It is about recognizing that fear-driven sell-offs, the kind triggered by a single press conference, or a handful of policymakers floating the idea of a rate hike, tend to create the best long-term entry points for investors willing to look past the next 24 hours and focus on where these businesses will be in 5 or 10 years. One more thing before we wrap up, because I think it is just as important as the stock picks themselves. None of these 5 names should make up your entire portfolio, and I would never suggest going all in on any single idea, no matter how confident I sound about it. The way I personally approach a list like this is to build positions gradually, adding a little at a time, rather than putting everything to work in one afternoon, especially during a stretch where the broader market is still digesting new information about where interest rates are headed. That kind of patience protects you from the one risk that quietly ruins more portfolios than any bad stock pick ever could, and that is putting too much money into the market at exactly the wrong moment out of fear of missing out. Spreading your buying out over weeks or even months, staying diversified across different sectors the way these 5 names already are, and keeping enough cash on hand that a rough week never forces you into a decision you will regret. That is what actually separates investors who are still standing 10 years from now from the ones who got shaken out during the first real test. I will say this every time because I think it matters. None of this is financial advice. I'm simply walking you through how I am thinking about this market and the companies I am personally paying attention to. So please do your own research and make decisions that fit your own situation and your own risk tolerance. If this video helped you think about the market a little differently today, do me a favor and hit that like button. It really does help this channel reach more people who are trying to invest seriously for their future. And if you know someone, a friend, a family member, anyone who has been sitting on the sidelines wondering whether this pullback is a reason to panic or an opportunity to act, go ahead and share this with them. It might be exactly what they need to see today. Drop a comment below and let me know which of these 5 names you are most interested in. I genuinely read through them and I love seeing what you are all watching right now. Make sure you are subscribed to Ticker Hawk so you do not miss the next breakdown, because markets like this one move fast, and the investors who stay informed are the ones who end up ahead. Thank you so much for watching. Take care of your portfolio, and I will see you in the next one.